Cathie Woods is one of the most respected figures in the world of investments, having over $45 billion worth of stock on her portfolio. Her moves are praised and replicated by many new investing enthusiasts. With that being said, we need to make sure that our viewers make the right decisions when investing and don't just fall for the hype. Today, we're discussing the best stocks that Cathie Woods have also shown close interest to, and which she, among other well-known investors, thinks will be profitable throughout 2021. But before we move on, I need you to stop just here for a second to remind you that this video is for entertainment purposes only. I am not a professional financial advisor, and I can't tell anyone whether to invest in something or not. I just research, which is something I enjoy doing, and enjoy sharing the gathered information with you guys too. With that being clear, let's get into the video. Cathie Woods is holding many popular well-known stocks, but let's begin with the first stock on her portfolio which she holds the most shares of. Cathie is holding over $2 billion on Elon Musk's futuristic company, Tesla. Now, with all these other electric vehicle companies and startups taking their time to perfect their art and trying constantly to outrank Tesla's vehicles, would it be a smart investment to put your money in Tesla? I would say competitors are not your toughest enemies when investing in EV stocks. Don't believe me? Let's go back in March of this year when the last EV stock bubble was created. People freaked out and started selling their shares for so low that Tesla stock experienced a 20% loss that needed 6 more weeks to recover from. With that being said, you need to understand the consequences when investing in not just Tesla, but every EV stock out there. Now that you're informed about Tesla, let's dive into Tesla's future projects. Elon Musk emphasized that the world would need significantly increased battery manufacturing efforts to complete the transition from gas guzzlers to electric vehicles. As a result, Tesla plans to ramp up its presence in order to achieve 100 gigawatt-hours of battery capacity by 2022 and 3,000 gigawatt-hours by 2030. Being that the world is switching from fossil fuels to electricity, and Tesla being a big provider for not only their company but also for Mercedes-Benz, which is a luxury vehicle, well-known company with over 2 million cars sold in 2020 alone, a number almost 5 times higher than how Tesla itself performed, we can only assume that their partnership will be a highly profitable one, driving Tesla stock towards success in the following years. Energy storage, in comparison to energy generation, may prove to be a profitable product for Tesla in the long run. Despite the fact that Tesla does not provide detailed breakdowns, the financial patterns in the 10Q commentary seem to indicate that storage may have positive gross margins. Space, unlike solar energy leasing, is not burdened by project debt or VIE fees. I can definitely say that Tesla stock is one to keep your eyes on. Featured in number 2 is none other than Spotify. Founded in 2006, the Swedish audio streaming and media services provider has been keeping a steady growth over the last 2 years, as can be seen in the chart. Now, the stock is not doing so good, and we can assume it has something to do with all the users complaining about the mobile app version. Seemingly, people have had many issues while using the Spotify app, mentioning taking too long to respond, songs unable to rewind, songs not playing, and many more. Even while you can find reviews like these regularly, the app has managed to keep a review ratio of 4.8 stars on the App Store, but they couldn't keep the stock price up seemingly. Anyways, the platform has got the most hype recently, hitting more than 345 million users worldwide in the last quarter of 2020, so we can assume the price for the stock will go up a lot more this decade. Why do we think so? Spotify has spent a lot of money on podcasts, music, sports, and entertainment, among other things, to broaden its original content roster. In February of this year, they acquired Anchor, a platform that allows users to make and distribute podcasts. Spotify has incorporated Anchor into their structure in producing music chat shows that are similar to radio shows, with the exception that audiences can connect with the shows directly and add songs to playlists. Artists can also use Anchor to make a podcast show with their own songs, giving them more creative power. In the same month, they purchased Gimlet Media, a company that creates independent podcast content. In the last 2 years, they've added Parcast, The Ringer, and Megaphone, all of which specialize in podcast technology. These investments can only benefit Spotify in the long run, particularly as the industry consolidates. Spotify has the advantage of being one of the few mainstream music outlets in streaming. However, it must effectively manage its business in order to produce revenues. The business does not pay a dividend and often experiences negative returns. It was finally reaching its stride in 2019 with return on equity in the double digits, but by 2020 it was back to the doldrums. Spotify is a one-of-a-kind company on the niche it operates in, and its current price point could be justified. Being Apple Music's most direct rival, its investments in original content can only benefit the company. Overall, Spotify has been on a roller coaster ride, but it has a promising future ahead of its investors. On number 3, we have the well-known media streaming company Roku. In May 2008, the first Roku model, created in collaboration with Netflix, was released. Roku devices have had a significant impact on the digital media player industry, popularizing the idea of low-cost, small form factor set-top boxes for over-the-top media consumption. However, things haven't been going so well for Roku. After Netflix's latest earnings disappointment in late April, the Roku earnings report was highly expected. Since streaming is an industry that is considered to have gained greatly from the pandemic, and as customers start venturing outside the home again, COVID stocks are starting to fall out of favor among investors. Some Roku investors were concerned that weak earnings by Netflix would mean poor results from Roku. Roku's earnings, on the other hand, tend to support the argument that Netflix's loss is Roku's benefit, as Netflix might now be facing valid competition from other streaming alternatives such as Disney+. The availability of more viewing options seems to support Roku's business model over Netflix. COVID stock's secular growth tale of more customers cutting the cord to seek more streaming options appears to be winning out over Roku. Although not exceptional in comparison to subscriber growth in 2020, Roku's growth did not fall off a cliff. Roku added 2.4 million new accounts in the third quarter, bringing the total number of accounts on the platform to 35 million, up 35% year over year. Roku's engagement figures soared, with audiences watching 18.3 billion hours of content on the platform in the first quarter, up 49% year over year. Total sales for the first quarter of 2021 rose by 79% year over year to $574.2 million, exceeding analysis estimates by $82.90 million. Revenue from the platform segment increased by 101% year over year to $466.5 million, accounting for 81% of total revenue. Player sales increased by 22% year over year to $107.7 million, which was in line with company expectations. Since COVID-19 accelerated Roku's growth last year, there has been a belief that Roku is just a COVID match, and that once the economy reopened, Roku's growth will come to a complete halt. So far, Roku's story isn't really coming together. While the pandemic may have pushed some demand into 2020, consumer growth has remained strong this year. As previously reported, the company added 2.4 million accounts in the quarter, bringing the total number of accounts to 53.6 million. Roku is now available in over 40% of broadband households in the United States. Roku took advantage of the increased use in a way it had never done before. Roku's average revenue per user rose by 32% year over year. The rise in monetization is attributed to rebounding ad spend, new ad targeting products such as recently acquired Nielsen video advertisement business, and massive growth from the Roku channel, which reached an estimated 70 million people in US households during the quarter, more than doubling viewers from first quarter of 2020. Roku did really improve its cash and liquidity position in the first quarter by raising $1 billion in additional equity capital through an at-the-market offering in March. Roku had $2.1 billion in currency, cash equivalents, restricted cash, and short-term assets at the end of the first quarter. Another intriguing aspect of Roku's robust advertising platform is that it has evolved into one of the most important platforms for content creators to promote both their OTT streaming service and their content. Now, with having analyzed the top 3 stocks Cathie Woods is holding, I can say that we've come to the end of this video. As I also mentioned earlier in this video, make sure you do your own research before deciding to take any kind of action. The only action I will ask of you to take care of is smashing that like button, subscribe to our channel, and hit the bell icon for notifications whenever a new video is published. Good luck and happy investing!